Did you know some savvy investors are pocketing over 10% in dividends annually with certain ETFs? Well, in the world of investment, combining steady monthly income with significant growth is often seen as a challenging feat. Yet, it's entirely possible with suitable monthly dividend ETFs, which not only offer impressive returns, but also enhance portfolio stability. Each of these carefully selected ETFs provide a unique approach to achieving high yield and low risk, appealing to a broad range of investment strategies. So, in today's video, we'll be unveiling 5 such ETFs, each a standout for its robust dividend payouts and potential for capital appreciation. Without further ado, let's get into it. 1. JP Morgan Equity Premium Income ETF NYSEARCA:JEPI. Let's begin by diving into one of the standout monthly dividend ETFs, the JP Morgan Equity Premium Income ETF, ticker JEPI. What makes JEPI truly exceptional? Well, to start with, this ETF offers a jaw-dropping dividend yield of 11.5%. That's right, 11.5%, and it's been consistently delivering this since its launch in 2020. Now, JEPI just isn't any fund. It's a behemoth with more than $21 billion in assets under management. That's a lot of trust investors have put into this fund in a very short time. But how does it manage to keep things steady even when the market gets rough? JEPI has a unique strategy that involves selling options and investing in sturdy US large cap stocks. This dual approach not only generates income through option premiums and dividends, but also aims to smooth out those nerve-wracking market dips. Speaking of investments, JEPI doesn't shy away from innovation. It allocates up to 20% of its assets in equity-linked notes and hedges with call options on the S&P 500. While this strategy proved its mettle by protecting investor capital through the tumultuous 2022, it's important to note that it might curb the gains when the bulls are running. But that's exactly why JEPI might be the perfect candidate for those looking to add a layer of stability to their portfolios. Now, let's talk about holdings. JEPI is no small fish. It's diversified over 116 holdings, but its top assets, representing just 16.7% of the fund, are from some of the biggest names in the business. We're talking about heavyweight champions like Coca-Cola, Pepsi, and Hershey. In the financial corner, giants like Visa, MasterCard, and US Bancorp make an appearance. Not to mention healthcare leaders like AbbVie and Bristol Myers. With an expense ratio of just 0.35%, JEPI is efficient and highly recommended. It holds a neutral ETF Smart Score of 7 out of 10, with a bullish outlook from bloggers and strong confidence from the investment crowd. Analysts are calling it a moderate buy, and why not? With an average price target suggesting a 13.6% upside, it's clear why JEPI could be a smart pick for those seeking both growth and income. So, if you're in the market for an ETF that delivers robust monthly dividends and can play defense when needed, JEPI might just be your next portfolio addition. 2. JP Morgan Nasdaq Equity Premium Income ETF NYSEARCA:JEPQ. This is a fund that not only targets the cream of the tech crop by investing in the Nasdaq 100 index, but also spices things up by selling covered calls. This strategy allows JEPQ to pay out a hefty 9% dividend yield. Yes, you heard that right, a 9% yield. In a world where typical US equities might offer you a mere 1.4%, and even the sturdy US 10-year treasuries hover around 3.9%, JEPQ stands out by providing more than double the punch. Launched in May 2022, JEPQ has quickly ballooned to an impressive $11.6 billion in assets under management, showcasing its popularity and investors' confidence in it. It's not just a passive basket of stocks. JEPQ is actively managed by a trio of investment veterans led by Hamilton Reiner, who has been in the game for over 3 decades. This expertise in equities and equity derivatives shape the fund's strategy, ensuring it remains robust even in volatile markets. The fund isn't just playing it safe though. While many dividend-focused ETFs lean towards high-yield stocks with minimum growth prospects, JEPQ breaks the mold. It offers exposure to leading tech giants. Think Microsoft, Nvidia, Amazon, Meta Platforms, and Broadcom. These behemoths lead the charge in the stock market, combining growth with profitability. All this is for a modest expense ratio of 0.35%. That means that on a $10,000 investment, you only pay $35 annually in fees. The potential growth and income it provides is a deal that's hard to beat. 3. Invesco S&P 500 High Dividend Low Volatility ETF, SPHD. Next, let's unpack a gem in the ETF world, particularly for those who crave stability mixed with attractive returns. The Invesco S&P 500 High Dividend Low Volatility ETF, commonly known as SPHD. Why does SPHD stand out? It operates with a clear mission: to mimic the S&P 500 High Dividend Low Volatility Index. And well, it isn't just any index. It's a carefully curated mix of 50 solid performers from the S&P 500, chosen not just for their robust dividends, but also for their calm nature in turbulent markets. The selection process is rigorous. Starting with the top 75 dividend yield stocks, it then hones in on the 50 with the lowest volatility. The result? A portfolio that acts almost like a bond, offering you a smooth ride and reliable payouts. But there's more to SPHD than just calm and collect. Over the past 5 years, this ETF has delivered a strong average yield of over 4%. That consistent performance is hard to ignore, especially in an unpredictable market. And with its broad sector diversification, from utilities and consumer staples to real estate and energy, SPHD ensures that your investments are spread across various industries, reducing risk and increasing the potential for returns. One of the notable strengths of SPHD is its top holdings, which include high-yield stalwarts like Altria, Verizon, and Kinder Morgan. These companies are not just random picks, but strategic choices contributing to the fund's overall stability and performance. When it comes to cost efficiency, SPHD boasts an expense ratio of just 0.30%, aligning it with the best in the business. This low cost means more of your investment goes towards growing your wealth, not paying fees. So, if you're looking to complement your tech-heavy investments with something a bit more grounded, or you're just starting out and want a fund that offers both safety and growth, SPHD could be your perfect match. 4. Invesco S&P 500 Low Volatility ETF. Now, are you on the hunt for a solid investment that offers a gentle ride through the rough waters of the stock market? Then, let's shine a spotlight on the Invesco S&P 500 Low Volatility ETF, known as SPLV. Looking into the scope of SPLV, this ETF is a powerhouse in the large-cap blend segment of the US equity market, boasting over $7.68 billion in assets. So, why are large-cap companies so appealing? Typically, these firms are industry leaders with market caps above $10 billion, renowned for their stability and predictable cash flows. This makes them less susceptible to the wild swings often seen in smaller companies. SPLV is not just any blend ETF. It masterfully mixes growth and value stocks, embodying characteristics of both to offer a balanced investment option. With an ultra-low expense ratio of just 0.25%, it positions itself as a cost-effective choice for long-term investors. But let's delve deeper. SPLV isn't about just hugging the road, it's about smooth sailing. The ETF targets the S&P 500 Low Volatility Index, selecting the 100 stocks from the S&P 500 that have shown the lowest realized volatility over the past year. So what does this mean for you? Well, it translates to less turbulence in your investment journey and a more comfortable ride. Diving into the sectors, SPLV strongly prefers consumer staples, which comprises about 23% of the portfolio. It's a strategic choice as these goods are always in demand, recession or not. Utilities and healthcare, among other stability bastions, round out the top 3 sectors. Highlighting a few star players, SPLV boasts holdings like McDonald's, Coca-Cola, and even the conglomerate giant Berkshire Hathaway. These heavy hitters are not just random picks, they are calculated moves to anchor your investments with firms that deliver consistent performance. And how's it doing? SPLV has added a robust 5.70% this year, up approximately 10.27% over the last 12 months. With a trailing dividend yield of 2.34%, it provides growth and rewards investors with a steady income. 5. Global X Super Dividend US ETF, NYSEARCA:SDIV. If you thought dividends couldn't get more exciting, wait until you hear about SDIV's whopping 13.8% yield. That's right, 13.8%. It's among the highest in the ETF sphere, surpassing many others, including JEPI and JEPQ. SDIV might be smaller, with $790 million in assets under management, but don't let its size fool you. This ETF packs a global punch, investing in 100 of the highest yielding stocks globally. Unlike its peers, JEPI and JEPQ, which are more US-centric, SDIV brings you a slice of the world with only about 30% of its holdings based in the US. The rest spans diverse markets, from Brazil to Hong Kong, China to Great Britain, and even down under to Australia and South Africa. This international flavor diversifies your portfolio, tapping into unique opportunities in emerging and established markets. SDIV is quite eclectic in its selection, holding everything from REITs to midstream energy companies to shipping firms. This mix makes SDIV a bit more adventurous in terms of volatility compared to the usual blue-chip dominated funds. However, this might be a trade-off worth considering for those seeking substantial yields and monthly payouts. Speaking of consistency, SDIV has an impressive track record with dividends. This fund has reliably paid out monthly for over a decade, 11 years and counting. It's a testament to its enduring appeal and management's commitment to returning value to its shareholders. However, it's important to note that SDIV does come with a higher expense ratio of 0.58%. While this is above what you'd find in JEPI or JEPQ, the potential returns from such dividends could justify the cost for those looking to maximize their income potential. So, if you're intrigued by the idea of high yields and global exposure, the Global X Super Dividend US ETF could add a vibrant edge to your investment portfolio. And there you have it. Each of these ETFs has unique strengths and caters to various investment strategies, proving that growing your wealth through dividends is achievable and smart. Now, I'd love to hear from you. Which of these ETFs caught your attention? And how do you plan to integrate it into your investment portfolio? Comment down below. Don't forget to leave a like, subscribe, and turn on the notification bell.